invest in and follow principles. That has proved to be pretty successful.
This landlord's going to make almost $2 million over the next 12 years for doing something one time. And that's like residual. This guy's got another 7 retail spaces and he's got 10 stories of apartments above it. And I'm like, man, I'm on the wrong side of the coin, right? I need to own real estate, not broker it.
You start doing deals that are absolutely life-changing, like that put you on the path for intergenerational wealth.
Welcome to the Real Estate Home Runs Podcast. I am your host, Louis Van der Horst. This is a podcast for busy professionals who want to learn about passive income producing strategies that have helped others crush it in the real estate world. Whether you are a new or seasoned real estate investor, this is the podcast for you.
Welcome to the Real Estate Home Runs Podcast. Today we welcome our guest, Sandhya Seshadri. She holds a bachelor's and master's degrees in electrical engineering as well as an MBA. She has invested as a limited partner, key principal, and or general partner in 3,000 plus doors totaling $200 million in assets throughout the United States. She first moved into commercial real estate due to the tax advantages and the ability to uniquely force appreciate each asset, and it has become her mission to help other people capitalize on all of the benefits of real estate investing. Sandhya has lived in the Dallas-Fort Worth area for over 30 years and invests in the local multifamily real estate community, and also has a network of investors throughout the United States. Her knowledge of the local market and neighborhoods make her the ideal boots-on-the-ground asset manager for properties in Dallas. Today we discuss property underwriting, large apartment buildings, and syndication. Welcome to the show.
Welcome back to the show, everyone. Today we have a very special guest, Sandhya Seshadri, who I heard for the first time at the Raising Money Summit with Adams, and was impressed and was like, I can't wait to reach out to her and see if I can get her to be a guest in my podcast. So I'm really excited to have you here.
Thank you so much for having me. It's always a pleasure to speak in a podcast and add value to any audience.
Tell us a little bit more about yourself, how you got started, and what is it that you do in real estate?
This real estate is my third career. I am just like a typical Asian geek. I went to school, got a job, studied electrical engineering, worked for a local company and loved it, and realized very quickly that all the marketing and sales types make all the decisions and we engineers just execute their plans. So I got an MBA that my company paid for, then went into the stock market with that knowledge. And after that, I realized that every rich person I knew had something to do with real estate, and it's also got its tax advantages. So I'm now full-time into apartment investing, and I skipped the single family route only because whenever I did the numbers for it, I just couldn't justify the amount of time and effort it would take on my part. And also, my background is not in being a handy person. I didn't grow up with a dad who was great with tools, etc. So I really don't know how to fix up something. And so I figured I would get that call, on Thanksgiving dinner, I would get a call saying somebody has a leaky toilet and I wouldn't know how to fix it. So I kind of stayed away from single family for that reason. And when I heard that with multifamily, you have a third party property management company who will take care of all the day-to-day operations and you would be an asset manager. That's when it started making sense because then I would review the KPIs, I would visit the property as needed. But overall, the numbers work to where you have other people doing a lot of the, shall we say, day-to-day grunt work for you. And that's why large multifamily makes a lot of sense to me as a great investment.
And how long ago did you start, or for how many years you have been doing it?
It's been 3 years now that I've been in multifamily and I've really enjoyed the experience. I started out investing passively and I learned from others by seeing what worked for them in their deals. And then I got my knowledge. I also joined a mentoring program and now I've networked with a lot of people. So I started syndicating my deal about 2019. And acquired my first multifamily property here in Dallas area. So I'm based in Dallas. I've lived here for over 30 years. So I really know this market really well. I know the city, I know the little subdivisions, I know the safe areas, the high crime areas, the areas to avoid, etc. So I think you got to pick whatever is your biggest strength. And for me, it was being a boots on the ground to sort of find your first deal.
And what was that experience that like or journey to finding your first multifamily? And was that as a LP or as a general partner?
The very first deal I did invest as a passive investor, which is an LP or limited partner. And that was at the very beginning back in 2018 when I got started. And when I invested in multiple deals as an LP, I actually used my retirement funds because those are funds that you cannot use to syndicate your own deal or to be a GP. So it was an excellent way to use that money instead of leaving it in funds and things that I don't normally monitor very closely. I could instead take it out and put it into real estate and build relationships with experienced sponsors and learn the business that way, learn what works in this market, et cetera, and use that as my vehicle to go ahead and syndicate my first deal.
And another thing is that we also don't have much control over those retirement funds.
Yeah, you have no control at all. You hardly have any idea what even the fee structure is in many of them. You don't get to trade them in and out like you do even individual stocks. And of course, you don't get to go speak to the head of the fund to say, why are you investing this way or that way? Versus, in a syndication, you get monthly reports. You get to ask the syndicator, hey, what about this? Why have your, numbers fallen this month? Or what are you doing to improve this? And in my case, I invested in properties in my local market. So I could literally drive and see those properties. So because my goal was also to learn the business this way, I was what I called an active passive investor. So I didn't just put my money away into this investment and sleep. Instead, I did get my mailbox money, which was great, but I also used this as an opportunity to learn the business, to do my own deal. And I think it's one of the best ways. It's sort of like your training wheels, before you bike on your own. So this is, I think passive investing did exactly that for me.
That's good. And no phone calls from tenants or about toilets and different issues.
None of the 3 T's, tenants, toilets, and trash. Didn't have to deal with any of that as a multifamily investor because the properties are large enough that you have property management company handling all the day-to-day work for you.
What is one of these deals that you have done? How many doors perhaps? What did it look like for you? What made you want to take that step to actually go for it?
My first deal was 86 doors. It's in a place called Cleburne, Texas, which is not far from Dallas. It's about 30 miles from Fort Worth. The reason I went after that deal was because the financials work. So the first and foremost thing is, I think with any investment vehicle is the education. So you want to make sure you fully understand how to underwrite an investment opportunity, or you want to have one of your partners to be really strong in that. So in my case, with my engineering background and my love of spreadsheets, numbers and math was my thing. So the first thing you always do is you underwrite the deal and you make sure the numbers make sense and you can execute a business plan to where you can afford this third-party property management company and you can still make money with it. So there were a lot of exciting things in this property that made sense. So when I toured the property, the broker, he certainly had some ideas. You certainly look at the offering memorandum of the deal and you get your ideas. But when you actually tour the property and then you do what is called shopping the comps or the comparable properties nearby, then one of the most important things for any deal to work is how do you justify increasing the rent? How can you add value in a way that the tenants will pay that extra for? And how does your property compare to the rest of the properties in that market? So what we call a comp analysis has to be very thorough, right? It's like when you look at single family residences, you don't want to be the white elephant on the street, right? You don't want to be the most expensive house. So similarly, you kind of want to make sure that when you're increasing your rents, you don't get to be the most expensive property there, and then no one wants to rent at your property. So a very important part of this analysis is the comp analysis, and that made sense for this property. We were like a couple of $100 below market on most of the units in the rent roll. So that was a big piece of it. Another big piece when I toured this property was that the leasing office was occupied in one of the largest units there. This property had townhouses on one side and apartments on the other side, and then a single family row of homes behind it. So it was a very safe and nice neighborhood. But the largest unit, which was the townhouses, which was 2 stories, 2 bedrooms, 1.5 bath, is where they had the leasing office. So immediately I looked at other places where we could relocate it so that we we could get an entire unit out of it. And that's exactly what we did. So that's one of the first things we did when we took over the property. So right away, we spent about 25, a little under 30,000 to build a new leasing office that included getting this unit ready to rent to another new tenant, etc. And we got over $1,200 a month in rent from it. And so, right there, you're talking 14.4K a year. That is just pure NOI number. And you added one more unit to this mix. So now when you turn around and get ready to sell the property, that's an extra unit. So just like that, that was one of the most important things. The other one was this property was all bills paid, which is a unique thing in there. There were not that many properties that were all bills paid. And that kind of was a differentiating factor in the sense that tenants really love the idea of knowing what their bill is going to be for any month of the year. Because in Texas, especially, the summer months, your air conditioning bills could be like 2x what it, averages for the rest of the year. So it's very nice for some tenants to know that. So when we went in with an all bills paid property, another thing you can do is water conservation. You just switch it out. This was an old property built in the late 60s. And so when you switch out all those, 3-4 gallon toilets to these 0.8 gallon brand new toilets, right there, you save a ton of water. The savings alone would be like a huge impact to your bottom line again. Another thing we discovered was being this older property, the LED lights had not been replaced at all. So it was the older kind of lights that just consumed a lot of power. So we switched it to LED lights and saved a bundle. Again, all of these savings directly impacted us because it's an all bills paid property. So it's not like you were doing RUBS, which is called ratio utility billing. So if you're billing the tenants for it and you implement all these things, then a lot of the savings is passed on to the tenants, which is a good thing, right? Because you're still conserving energy. But in the case of this deal being all bills paid, it was again more direct impact to our operating income. So several things like this made a lot of difference. Another thing we noticed, because we were so close to a residential street, is all of these townhouses, we were able to build these privacy fences that immediately gave us like a $50 rent bump. We did a survey of the tenants and then we built it. And so they were all very interested in having that because it was room for them to let their little pet out, or like a toddler could roam there. So we actually had a few tenants switch from the apartment side to the townhome side just for that reason, is it felt like a single family home. And that again made that very popular. There were several different things that we knew we could implement right away that made sense for us to impact the NOI. So again, a very thorough and detailed analysis of how your business plan can be executed to meet the returns for your investors is very, very important to take into account. Another thing I like to do up front when you're analyzing a property is to make sure whichever property management company you hire has local experience in that market. So a lot of the property management companies we talked to had experience in the Dallas metro area, but they had never been out to this little town called Cleburne. So we actually ended up hiring a company that was managing another property just down the street from ours. And you want to know this because even though it's only 30 miles from Fort Worth, the demographic there in that little town is so different. So you need to know what works there and what doesn't work there. For instance, a lot of people advertise on all websites like apartments.com, etc. So their marketing budget is at least $500-600 a month just from doing things like that. We realized pretty quickly, because of this company's local knowledge of the market and our leasing manager's proficiency there, that most of her leads come from drive-bys and word of mouth and flyers that she just puts out. So we were able to cut that right away. So we right there, cut our expenses by several $100s a month. And we turned it instead into incentives for her. So what we did was, whenever there were renewals coming up, and we were able to get it up to pro forma rent, we rewarded her based on renewals. And the reason you wanted to focus on renewals rather than new leases is because when you renew, you don't have to deal with the cleanup after a tenant moves out and unit turns, because those take away several days, maybe even a couple of weeks sometimes. And you have to completely pay for cleaning services, upgrades, refacing this and that. So instead, we just have a letter to our tenant and say, okay, we want to reward you for being a loyal tenant. Can we give you a new fan? Or can we upgrade your appliance or something? So we just upgrade one thing for them and they're really happy, because a unit turn can cost you several $1,000s, right? So, and the cycle time that is lost, those are like empty seats on a plane that's taken off. You can never recover that. So when we figured out that all we have to do is stop this advertising and take that budget, give her small incentives to our leasing manager for the renewals. That impacted our NOI in a very positive way. And the same thing with our maintenance staff to keep the work orders down and measure them by the satisfaction survey that we did of our tenants. It's another big way to keep your tenants loyal tenant space, right? Because unit turns really can hurt you in terms of money, cycle time, and lost rent, right? Lost to lease. So all of that you can overcome by just giving tiny rewards to your management companies, employees, to do the right thing by your tenants, and you retain them. If they're happy, they're going to stay. So again, the biggest bottom line, I think, is to recruit and retain the right tenants for your property who pay well and who stay. And so we've built a database. We have some tenants who've lived there, I think, like 7-8 years in the same property. And that's not common for apartments.
That's really good. And a lot of great information that you gave us in practical ways that we can improve the rents and be able to keep that tenant satisfaction and have a good relationship with the property management companies as well, since they're players they're part of the team. What is the usual price per door that you feel comfortable paying in that market down there?
I think you really have to know the age of the property to be able to calculate that. But for example, for that property, I would say in the 80s, 80K per door. For that type of property is reasonable in today's market. If you go beyond 100, 120 kind of K kind of values, you're talking about newer properties. So it could be 80s built and class A, which is much more recent, 2000 and up kind of built properties. So depending on the age of the property, there's a certain amount of deferred maintenance you'll have to do. And also if it's an older property like that, they probably don't have washer dryer connections and things like that. So a lot of the amenities that your, shall we say, your newest Tesla employee might expect in a brand new class A apartment, right, is different from this is more workforce housing. This is median household income in the 50s and 60s kind of neighborhood. So, our tenant base tends to be people who work in the local pasta manufacturing plant or, work in the local Walmart, et cetera, those kind of demographics. And demographics is another very important piece of it, because I have another property that has more of a predominantly Hispanic vibe to it, versus this one has a more Caucasian vibe to it. So the way that the tenant base behaves and what they like to see, and therefore the amenities you provide them, is going to vary depending on the location. Right? So we're planning to put a little soccer area for our more Hispanic property, because that's what they love to do. Is they have a lot of kids and families, and they invite their own friends and cousins, everyone, to move into the same apartment. And so if you cater to their children and those kind of amenities that you offer them, then they'll all stay, because they like to have larger common areas where all the kids get together and play, so that every parent doesn't have to come in there and supervise everything. And so you do things to keep it safe and keep them all in there, and they'll stay. But again, when you underwrite a property, like I said, I think that's the topic where we started off, you look through the business plan and see if that community will pay and benefit from that. So you might want to go in there and put a nice pool in there, right? But a pool is a very expensive thing to build or maintain, and that demographic may not need it or appreciate it, right? Your rent has to be able to cover whatever new thing that you're planning for that property. And it's very important to thoroughly understand your local market and the amenities offered by nearby properties to do a proper comparison and see what makes the most sense. So again, I recommend when you buy a new property is to always wait and learn and observe before going in and starting to make a lot of new things. Just go in there, observe, learn what that tenant base likes and does before you start making major changes. A lot of people are tempted to go in and do large exterior updates, such as paint, cosmetic things, new signage, rebranding, and all that. I would say, see if you need to fix something else from the inside out, like address the bones of the property first, right? And make sure the skeletal system is strong, the foundation is strong, etc. And do your cosmetics last. Because if you have a whole bunch of contractors up there digging up things and making a mess, you don't want that to be happening after you've done your cosmetic updates. So I would do cosmetics last, and I would hold on to some of my reserves and a lot of my capital expenses, because you just don't know what is in store for you, especially in 2021 with the eviction moratorium. You don't know what your delinquencies are going to be. So you want to be flush with cash, and you want to do things that immediately impact the NOI first and observe the property. So another thing that we do is you want to get the best tenants, you want to get them to stay, and you want to address delinquencies. How do you address delinquencies, right? That's going to be the biggest topic. So if I was a passive investor waiting to invest in a deal, and there's dime a dozen deals coming by these days. So one of the most important questions I ask is, what are your strategies for addressing delinquencies? And if this person has no answer, then I ask them, okay, who is your primary asset manager? Because there's a lot of people who purely raise capital, but they don't actually manage the asset. And I find that out right away. If they don't have an answer on how they can address delinquencies, it means they haven't been asset managers and they haven't looked into this. And you want someone with experience managing an asset in that local market before investing with someone, because it is your money. And when it comes to passive investing, you have hundreds of choices. So don't be in a rush to invest, is what I tell people. Get to know these sponsors well, get to know who is the primary asset manager and what is their experience level to be able to handle delinquencies. Another question I ask is, what is a stress test that you do now to tell me how well your property is going to do if there's a drop in collections? At what point are you going to be in trouble? So in one of my properties, when we did the stress test, we realized that we could last about 11 months at 50%, which is amazing.
Wow.
So we were very surprised that we could pay all our debts and operate the property, paying all our expenses, salaries, etc., and sustain it for 11 months. So that was pretty solid. The other property, we could take an economic vacancy, which is not just loss of rent, but all other reasons, bad debt, etc. We could take that for 8 months at a 35% economic vacancy, which is still very strong compared to a lot of other properties that are now in what we call forbearance. And forbearance is when someone's unable to pay their mortgage on a loan. And so they have to apply to Fannie or Freddie, where their loan is, and ask for help because they're not able to pay their debts. And you don't want to be in a deal which either does forbearance or a capital call. So a capital call is, again, a situation where the deal has spent all its cash, the operators haven't run it very well, or the situation is beyond their control to where they don't have money to pay their expenses. So they're coming back to you, the passive investor, and asking for more money because they can't meet their debt service. So that's a very bad situation to be in. And unfortunately, I was in one deal invested passively where that happened. And so because of that, what I've decided since then, that was actually my turning point to start doing only active deals from then on. And what I've done is only done my own sponsorship deals. And I have a checklist on how you vet a sponsorship team so that they go through that checklist. And only if it checks all the boxes will I invest in that deal. And I look at that when I'm investing as well myself. When I have a deal to present, I make sure that my deal checks all of those boxes before I present that deal to a group of investors. So if anyone is interested in that checklist, I have a website, multifamily4u.com, where the 4 is a number 4 and the U is YOU spelled out. And it's multifamily4u.com, where all you have to do is provide a name and email address, and I can email that checklist to you. It does not add you to my mailing list. You will not keep getting a mail from me every day and bombarded by junk that you don't need unless you opt in and you say, okay, yes, I want to receive messages from you. Because otherwise you won't hear from me. So there's just a free checklist as a resource. I say be very careful when you invest with people in these deals because we're talking large sums of money. A typical syndication, you're investing at least $50,000. Now I know how long it took me to earn that money from my first job, probably several years. many, many years of putting that into retirement account and saving it. So don't take it lightly and don't be pressured into investing. It's like, oh, don't have this, what we call FOMO, fear of missing out. There will be tons of deals again. You will not miss out on any deal. So do not feel pressured into investing in a deal that you don't like or you're not quite comfortable with or which doesn't check all the boxes. So local experience is extremely important in that.
Amazing content and feedback. Thank you so much for all of that. What would you say are 3 things that have helped you hit real estate home runs in your journey and your real estate career?
For me, the biggest one is persistence. I just don't give up. And just because someone did it a certain way, that may not be the same way that works for you or for me. We may not all have the same path. So if a particular way doesn't work, I would say go around, try other methods. Because the way I came to this country 30 years ago, and if I could mention that, my parents were fine and well off in India. But when you translate the currency to American dollars, it's less than $70 a month. It's around $60, $70 a month. That's not enough money to come to college here, but that's what I wanted. I wanted to come to college here. So, and my college cost me $20,000 a year back in the day. And for me to be able to do that, I knew I had to get a scholarship. There was no other way. Even if my parents gave me all their life savings, I wasn't going to quite cut it. So this traditional path is, I apply to college and I pay my way through college. Well, that wasn't going to happen. I had to come here with money to pay at least my first year's tuition, right? And I was able to do that only because I was able to get a scholarship, plus an additional stipend that gave me an extra money per month. So no matter how impossible a goal might seem, there is always a way. It depends on just how hard you're willing to work for it and how badly you want it will make you get creative in finding it. Like, you want to fly first class in an airline. Well, yeah, one way is to pay the full price for it. Another way is to pay for a coach class seat and see if you can get an upgrade. But then another third way could be, okay, do I have a friend who works for an airline? Can I get by on a standby ticket and paying only a small fraction of that cost? So there's different ways to do it. You just have to be willing to try, depending on how badly you want it. So persistence is a big one. For being creative is a measure of how badly you want something. And I think it's important to diversify your portfolio. So like as much as I loved stocks and know a lot about stocks, in March of 2020, when we all heard about this pandemic, there was that one day when my stock portfolio literally crashed, right? And its value dropped by a significant amount. And in contrast, at the same time, I had a real estate portfolio. Well, guess what? March rolled in, April rolled in, and May rolled in. And tenants were still paying rent. Most of them were still paying rent. Out of 86 doors in that first property, I think we had maybe 5 tenants who couldn't pay in full. They still paid a partial amount and eventually they were caught up. There was only one tenant who really sort of took advantage of the system and took his stimulus check, bought himself a big screen TV and refused to pay the rent. And so we were finally able to go and evict him. But all the other tenants stayed and they made their best effort to pay the rent. And whatever balance they owed us, we were able to spread it across the term of their lease. So, we work with tenants other than the one tenant who took advantage of it. So in contrast to my stock portfolio, my real estate portfolio was much more stable. So I like having a mixed portfolio in my investment toolkit so that you could take your high risk ones and you could take your more steady ones and mix it up. And again, the big advantage of stocks is that you can still make it immediately turn it into cash if you need it. It's liquid. With real estate, your investment is more long-term. It's 3 to 5 years on a typical apartment investment. So before you invest in an apartment syndication, you want to make sure you have at least 6 months of living expenses saved up. So that's another thing I tell, whenever I speak to potential investors, I say, do you have the sophistication to understand this risk? And do you have the financial, backing to where if this money doesn't come back to you in 4 or 5 years, are you okay with that? Because you don't want them to spend the last $50K of their savings in this one deal and then be waiting for it. That's not going to pay off.
And how can people stay in contact with you if they want to find out what Sandhya is up to or any projects you have going on?
And my website is the best way to reach me. It's multifamily4u.com, where 4 is the number 4 and it's YOU spelled out. So multifamilyforyou.com, and they can scroll to the bottom of that page and send me a message if they like, and we can certainly have a conversation after that if they're interested in getting in touch with me to invest in any future deals. But most of my deals that I do tend to be what we call 506B like boy, which means that I need to have a substantive relationship with this person before they can invest in any deal with me. A lot of people do what's called 506C like Charlie, and those tend to be the ones that are for accredited investors that can be advertised anywhere and even to strangers, but I don't do that. So I have to know my investors well. They have to know me well before they can invest with me.
Thank you for your time and your wisdom. I really appreciate it.
Oh, thank you for having me. It's such an honor to be featured here. I appreciate you. Thank you so much.
It's my honor.
We hope you enjoyed this interview and got some value out of it to help you in your real estate investing journey. If you can take just a minute, please do us a favor and leave a review. Hit the like button on iTunes or whatever platform you listen to our podcast on, and subscribe so you can hear future episodes. Also, don't forget to check out our Real Estate Home Runs Podcast community Facebook group, where you are able to connect with some great listeners. If you're an investor who is crushing it and want to share some information centered around passive income in real estate, please contact us. Hit those home runs, and we will see you next time.